morning, good morning, learners and viewers. Today we will take up 11th unit of MMPC 4, which is variance analysis. Variance analysis is intimately connected with budgetary control, which helps the management in planning their activities, comparing actual performance with the budgeted performance, identifying the variances as to their causes, ensuring that remedial measures are taken at the appropriate time. Now, the abbreviation of different variances are DMCV, direct material cost variance, DMPV, direct material price variance, DLCV, direct labor cost variance, DLRV, direct labor rate variance, DLEV, direct labor efficiency variance, variance of CV, overhead cost variance, VOCV, variable overheads cost variance, FOCV, fixed overhead cost variance, FOEX, PV, fixed overhead expenditure variance, FOVV, fixed overhead volume variance, SPV, sales variance, SPV, sales price variance, SVOLV, sales volume variance. Now, the direct material variances are of three types: direct material cost variance, direct material price variance, and direct material usage variance. The reasons for direct material usage variance may be agenda, inefficiency, lack of skill, or faulty workmanship resulting in more consumption of the raw material, lack of proper upkeep and maintenance of the plant and equipment, and frequent breakdown during the production process leading to wastage of material. Non-consideration of product design and method of processing, etc., while fixing standards. Incorrect processing of material resulting in wastage. Non-recording of returns of material to stores or inter-transfer from one job to another. Improper inspection and supervision of work may resulting in adverse quantity variance due to careless handling and processing. Too strict supervision and inspection resulting in excessive rejection of the materials. Substitution of specified material with unspecified material could be greater consumption of the latter. Price variance could be favorable because unspecified material is likely to be cheaper. Incorrect setting of standards leading to variances. Excessive wastage, scrap, spoilage, shrinkage, leakage, causing an adverse usage of variance. Direct labor variance, the deviation in cost of direct labor may occur because of the two main factors: difference in actual rates and standards, rate of the labor, and variation in actual time taken by workers and the standard item prescribed for performing a job on an operation. Now, the regions of direct labor rate variance may be deployment of more efficient or skilled workers giving rise to higher payment, higher payment due to shortage of availability of labor, lesser payment due to abundant availability of labor, high competition among them for employment, employment of unskilled labor causing lower actual rate of pay, extra shift allowances to workers or overtime allowance for the work done after normal working hours, leading to the higher wages, higher price rates for the better quality production, change in the system of wage payment from time wage to piece wages or vice versa, introduction or withdrawal of incentives or bonus schemes, change in wage rates probably due to a revised agreement with labor union, higher rate during the seasonal or emergency operations. The labor efficiency values may be caused by the following things: defective or bad material, breakdown of the plant and machinery, failure of power, efficient working by the laborers, and further utilization of time due to incentive given, loss of time due to delayed instructions from management or delaying receipt of raw material, alteration in the method of production, more time taken by workers due to lack of proper supervision and control by the management, making the workers lazy and inefficient. Too rigid a system of inspection and control, poor working conditions, lower productivity due to lack of training ability or experience on the part of the workers, Labor turnover or charges change over of the workers from one operation to or process department to another. The overhead variance term overhead includes indirect material, indirect labor, and indirect expenses. Overhead may relate to factory, office, and selling and distribution departments. However, for the purpose of variance analysis, we can broadly divide the overhead cost variance into two categories. Overhead cost variance, it is the difference between the standard overheads for the actual output, recovered overheads, and actual overheads. It is the total of both the fixed and the variable overhead variances. Overhead cost is equal to recovered overhead minus actual overhead variable. Overhead cost variance is the difference between the standard variable overhead for actual output, recovered variable overhead, and the actual variable overheads. VOCV is equal to recovered variable overhead minus actual variable overheads. Causes of variance. This variance may be due to advance payment of expenses or outstanding expenses or payment of past outstanding expenses during the period or on account of certain abnormal expenses incurred such as repairs of machinery due to breakdown expenses due to spoilage or defective workmanship and excessive overtime work. Fixed overhead cost variance is the difference between the standard fixed overhead for actual output or recovered overhead and the actual fixed overhead. FOCV is equal to recovered fixed overhead minus actual fixed overhead. Causes of variance, difference between actual and recovered fixed overhead may be on account of a higher or lower amount of fixed overheads compared to budgeted fixed overheads might have been incurred for the same production during the same period. The same amount of fixed overhead might have been incurred for a high or lower production than the budgeted production during the same period. The classification of fixed overhead variance may be classified as shown in the chart: fixed overhead expenditure or budgeted or controllable variance. This variance is due to difference between the budgeted fixed overhead and the actual fixed overhead incurred. The fixed overhead volume variance. This variance arises because of the difference between the standard and the actual output, resulting in under and over recovery of fixed overhead. It is therefore the difference between the overhead absorbed on actual output or recovered overhead and those on budgeted output. FOBV is equal to recovered fixed overhead or budgeted fixed overheads. Now the sales variance affected by two factors, the selling price and the quantum of sales. Now the variance, material price, quality grade department to be held responsible, purchase department, store purchase and processing department, as the case may be, waste, scrap or spoilage, production department, wages rate for difference rate at work, requiring higher rates of pay than personal department, production department, time, lack of proper supervision, production department, overheads, volume efficiency, sales department, production department, expenditure in higher rates of direct workers, higher price of different material, higher consumption of indirect material, the personal department, purchase department, and the production department. Excessive expenditure in factory production department, excessive expenditure for selling the selling department, sales price and volume selling department. Now the next unit is 12th unit, financial statement analysis. The annual report figure displays the four broad contents of the annual report: non-audited information, financial statement, notes to account, and accounting policies. Non-audited information further divided into two parts: narrative items and non-narrative items. Financial statements, balance sheet, profit and loss account, cash flow statement, then notes of account and accounting policies. The non-audited information is further classified into narrative and the non-narrative. Narrative, the narrative items, annual reports followed by some of the important statements of the chairman, director's report, operating and financial review, statement of corporate governance, auditor's report, statement of directors' responsibilities, their liabilities, sustainability report, and management discussion and analysis. The environment, reducing energy consumption of CSG emissions. This is governance. Social, engaging with network of suppliers and dealers and raising awareness on ESG aspects, health and safety parameters, technical factors, ensuring employee health and safety, providing a deserved and inclusive workplace, empowering communities with interventions in health, education, skill development, and rural development, among others. Governance ensuring compliance by introduce supportive policies and appropriate monitoring system. Industry recognition ranked among top 10 companies at the Responsible Business ranking. Emerged as a leader accounting to the benchmark reports in Global Child Forum. Boston Consulting Group titled as State Children Rights Business 19. Selected DGS 19. Received the Golden Peacock Occupation for Health and Safety Awards. Now the financial statements, there are three financial statements: balance sheet, profit and loss, and cash flow. The balance sheet is a statement of resources owned and owed by the business at a single point of time. It gives snapshot of assets, liabilities, and capital at a point of time. It provides information about the company's funds and how they are used in the business. Balance sheet, which is also known as position of statement, provides a bird's eye view on company's financial position and balance condition. This statement indicates whatever company has and whatever company owes. The axis of the assets or liability is known as the owner's equity or shareholders' funds. This is a balance sheet, non-current asset, other assets of a firm, then consolidated statement of profit and loss account as on 31st March 19 and 2020, the comparison, then consolidated statement of profit and loss account, a comparison of 2019 and 20, then the note to business, note to account, comparison of 2019 and 20. Profit for the period 2019 was 15,410 and it increased up to 16,639. Income and expenses, then note of accounts payment to acquire investment, certificates of deposit. Now depreciation, manufacturing estimate of useful life 30 to 60 days for building. Asset category, building, management estimate of useful life 30 to 60 years. Useful life as per schedule 2, 30 to 60 years. Plant and machinery equipment, useful life, management estimate 5 to 15 years. Useful life as per schedule 2, 10 to 15 years. Computers and servers, useful life estimated by the management 3 to 6 years. Useful life as per schedule 2 also 3 to 6 years. Furniture and fixtures 5 to 10 years. Useful life as per schedule 2 is 10 years. Office equipment 5 years. Schedule 2 also 5 years. Vehicles 4 to 5 years. As per schedule 2 it is 8 years. Now inventories, on the other quantities of gold and other prices as yet to be determined with the suppliers. Unfixed gold are stated at the lower cost and net realizable value determined on the item by basis. Gold is valued on first in first out basis. Stores and spares, loose tools and raw materials are valued on the moving weight average rate. Work in progress and finished goods other than gold are valued on absorption cost method based on the moving average cost of production. The traded goods are valued on the moving weighted average rate cost of purchases, fixed assets, share capital and furniture. Accounting policies, difference between the annual report and the public company and private company. An annual report may look different depending on the whether the company is in question is private or public. The three main differences are: first, in case of private companies, the annual report is prepared following Section 134 and other applicable provisions of the Companies Act 2013, whereas for public companies, the annual report is prepared following the aforementioned as well as Regulation 32, 34 and Schedule 5 of SEBI and LODR listing obligations and directions, disclosure requirement regulations. The second annual report is private company, one whose stock isn't traded on the open market, is usually a document that gives user just the mandatory information about how the company performed in the past year. That's because most private companies are closely held. They have a small number of owners, so they are not too concerned about how a larger audience will react to the report. On the other hand, a public company report is often loaded with bells and whistles, such as marketing material designed to tout the company to potential investors and creditors. Third, the annual report of a private company doesn't always have its financial statements audited, while public companies do. A private company usually has its financial statement audited only if doing so is required to fulfill the business purpose. The annual environment report for the government company, where the central government is a member of the government company. The central government shall cause an annual report on the working and affairs of the company to be prepared within 3 months of its annual general meeting, before which the comments given by the controller and Auditor General of India and the audit report is placed under the provisions of subsection 6 of the section 143, and as soon as may be after such preparation laid before both houses of the parliament together with a copy of the audit report and comments upon or supplement to the audit report made by the Comptroller and Auditor General of India. Whereas in addition to central government, any state government is also a member of the government company. That state government shall cause a copy of the annual report prepared under subsection 1 to be laid before the house of the both houses of the state legislative together with a copy of the audit report and the comments upon or supplement to the audit report referred to in section 1. Green annual reports are those reports, though they are similar with the general annual report, but they are printed with soy ink. SOY is the uh, name of that soy ink, while the general annual report are printed through the another petroleum based ink, which is not easily dissolvable, while the green report, which is printed through soy ink, uses less energy, less water, and uh, is beneficial to the environment as well as to the plants available in the country. Now, the comparative of common size trend, this is another unit type of ratios. The type of financial ratios, these are six ratios: profitability ratio, liquidity ratio, leverage ratio, coverage ratio, efficiency ratio, and valuation ratio. Profitability ratios are the ratios by which profit of the company or the unit is calculated through, is compared through the sales. Net profit divided by sales volume, gross profit divided by sales volume to arrive at the profitability percent. Then liquidity ratio are the ratios by which we can ascertain whether the company is liquid or not. Current liability divided by current asset. This is current ratio. And liquid ratio, quick ratio. Quick ratio is current asset divided by quick asset. By this, if the ratio is more than 1, it means the company is liquid. It can pay off its liability by its current asset. Then leverage ratios are those ratio which covers the debt equity of the company, how much the shareholders funds can cover the debt. This is the leverage ratio. We can say it debt and equity ratio. Then this is the trend analysis of the financial indicators of a fertilizer firm of India, company National Fertilizer, sales in millions, profit after tax in millions, then long-term borrowing, next fixed asset, equity capital, retained earnings. There are 15 companies in this list. One is Rashtriya Chemical, but of the same nature, doing business of fertilizer manufacture. Rashtriya Chemical and Fertilizer, Gujarat State Fertilizer for the phosphates, Samarchem Technology, Fertilizer Chemical, Travancore, Mangalore Chemical, Green Star Fertilizers, Kanpur Fertilizer and Cement Limited, Kripco, Southern Petrochemical Limited, Juari Agrochemicals, Madras Fertilizers, Nagarjun Fertilizers, and Rama Phosphates. So the sales in millions, this is a comparison of profit after tax, then long-term borrowings, then net fixed asset, equity capital, and retained earnings. Trend analysis of ABC sales 2016 taking as 100, then 2007 100 05, 1800 11.6, 19 120.3, 20 124.2, earning before interest and tax 98, 97, 126, and 138. Means during 19 and 20, the earning before tax is more than the benchmark. Interest 100, 186, 338, 364, and 372. Profit before tax in 1785, 76, and in 1900.5 and 107.7 in 20. Profit after tax, this is 83.4 in 17, 17.72.5, 94.6 and 93.6. Net worth of the company 17, 124.3, 145.4, 171.7, and 197.7. Total liabilities 146, 199.6, 232, and 272. Net fixed asset 186.1, 338.2, 364.3, 372.5. Current assets 121.4, 132.8, 166.3, and 209.3. Total assets 146.7, 199.6, 230.1, and 272. Now, the financial ratio of the fertilizer firm in India for the year 20, Digital Fertilizer NPM minus 1.33, Rashtriya Chemical 2.21, Gujarat State Fertilizer Chemical 1.29, debt equity ratio is 0.01. In case of Rashtriya Chemical, debt equity is 0.19, and in National Fertilizer it is 0.31. Sales to CE is 5.08, Rashtriya Chemical 2.48, Gujarat State Fertilizer Chemical 1.11, Paradeep Phosphates Limited 4.63%, 0.09 is DE, sales to CE is the 2.40, then Smart Chem Technologies 0.30%, 0.25 and 0.96, Fertilizer Chemical Travancore 35.15%, minus 1.84 and 6.70, Mangalore Chemical Fertilizer 2.38%, 0.41, 3.52, Green Star Fertilizer 1.84%, 0.13 and 9.11%, Kanpur Fertilizer and Cement 0.04%, 0.15 to 0.81, Karpo Fertilizer minus 1.12%, 0.64 and 3.36. Southern Petrochemical Industries Corporation Limited 2.70%, 0 and 5.27. Juari Agro minus 9.39%, 2.47 and 4.96. Madras Fertilizers minus 10.56%, minus 0.08 and minus 2.20. Nagarjun Fertilizers minus 102.43%, 0.27 and 3.2. Rama Phosphates 3.94%, 0 and 2.7. This is calculated using data from CMIE Progress database. Now, to point analysis, the most important aspect of a firm's operation is the rate of return of the firm is able to generate on the equity investment made by the shareholder. Equity shareholders are the real owners of the firm and take all the risk. Hence, the return on equity needs to be analyzed in a greater depth. This is achieved by the two-point analysis, which breaks down the ROE ratio into its three important components. These three components are performance measurement, are profit margin, asset turnover, and equity multiplier. These can also be written as product of the above three components as follows: net profit margin, asset turnover ratio. Now the equity multiplier, net profit margin indicates profitability, asset turnover ratio, evaluates the efficiency in the usage of the asset of the firm, while equity multiplier is a proxy of the financial leverage. Thus, the DuPont analysis highlights that a firm may increase its return on its equity by maintaining a high net profit margin, efficient use of total assets, and optimum leverage. If the return on equity falls, the firm must investigate these three financial performances measures to identify the reasons for such fall and take corrective steps. Now, the huge financial ratio to protect bankruptcy. Edward Altman, 1968, investigated cases of business failure in the US. In this study, he included a sample of 66 industrial companies, of which 33 were bankrupt firms and 33 non-bankrupt firms for 20 years, from 1946 to 65. Based on the data provided by the annual reports of the companies, Altman examined a total of 22 potential financial ratios, out of which he retained five ratios that had the highest significance based on statistical techniques that were most important ratios in predicting business failures. Altman used the multiple discriminant analysis, the MDA technique, which categorized firms into those that are likely to fail and those that are not likely to fail. Based on his study, Altman developed the following formula, which combines these five ratios and arising weight to each of these ratios arrive at one compromise score, which he called Z score. Now, the application of the financial ratios, assessing the performance of the firm, credit analysis, forecasting bankruptcy, valuing firms, issuing using financial ratios. The financial ratio are calculated based on the financial statements. No two companies are exactly similar in their asset profile, capital structure, technology being used by them, markets, products. Although the financial ratios have been defined as discussed in the previous chapter, there exists a wide variation in the definition of certain terms, which makes the comparison of ratio difficult. Besides comparing the ratio over time, they are sometimes compared with industry average also. Now, the next unit is human resources accounting. The human management by objective, employee attitude survey, HR reputation, open communication channels, transparent and high performance standards, remuneration and rewards based on performance, effective use of employee skill and abilities, employee participation in work decision, advancement opportunities, identification and developing high potentials. Typical HR costs are employment cost per hour, per hire, orientation cost, fair employment cost per complaint and cost for litigation, training and development cost for employee, total cost as a percent of salary, labor relation, cost for grievance, cost of work stoppage, compensation, compensation expense as a percentage of operating expense, total compensation cost, safety and health accident cost and cost of penalties and fines, benefit perquisites benefit cost as a percentage of the salary bill, healthcare cost for employee, overall HR cost as a percentage of operating expenses, turnover cost. Now, competitive benchmarking shows us the various indicators of the HR department. Employment, average days taken to fill open requirements, ratio of offers made to number of applicants, salary administration, percentage of overtime hours in straight time, ratio of average salary to midpoint by grade level, equal employment opportunity, ratio of EEO grievances to the employee population, minority representation by EEO categories, benefits, percentage of sick leave of the total pay, average length of time taken to process claim, training percentage of employee completing training program for job category, training hours per employee, work environment and safety, frequency, severity ratio of accidents, ratio of OSSA criterion to number of employees, employee appraisal and development, distribution of performance appraisal ratings, reliability of appraisal ratings, labor relations, percentage of grievance settled, average length of time to settle grievance, carriers ratio of promotion to number of employees, average year, month between promotions, overall effectiveness, turnover rate, and absenteeism rate. Now shows the various key indicators of the HR department employment. Uh, Now human resource accounting management decision tool, investment decision, human resource planning, performance management system, the training and development comparison, compensation management system, human resource accounting, major models, method based on cost, replacement cost approach, opportunity cost method, standard cost method, Flamholtz stochastic rewards valuation model, present value of net benefit obtained, Hermansen model, Hermansen's unpurchased goodwill method. Now, the historical cost approach in this one is the acquisition cost, another is training development cost, then welfare cost and other costs. These costs are capitalized. Acquisition cost is for recruitment, selection, and hiring placement. Then training and development cost of the formal training, on the job training, special training. Then development programs for the welfare cost on these programs, welfare amenities inside the organization, welfare amenities outside the organization, health of workers, safety of workers, welfare of workers. These are the other costs. Now, this was developed in 1965 by William C. Piley along with R. Lee Government and Eric G. Falamantos. Various costs incurred in the HR under four groups: acquisition cost, training, development, welfare, and other costs. Now, the replacement cost, acquisition cost, recruitment, hiring and placement, learning cost, formal training orientation on the job training, then separation cost, separation of pay. This is the replacement cost. Replacement cost model is bidding cost, then opportunity cost method. Now another is the forecast accounting introduction. Forensic accounting introduction, overview of fraud triangle, major corporate frauds, application of forensic accounting, type of frauds, fraud origin and accounting cycle, fraudulent financial reporting schemes, improper revenue recognition, other financial reporting schemes, its tool for fraud detection, methods of fraud detection, forensic audit techniques. An overview of frauds report to the nation 2020 published by the Association of Certified Fraud Examiners. In the study, they examined 2,504 fraud cases from 125 countries. These fraud cases had caused a total loss of more than $3.6 billion. A typical fraud case lasts for 14 months before being detected and caused a loss of $8,300 per month. It is estimated that organizations lose 5% of the revenue to fraud each year, with a median loss of $1,25,000 per case and an average loss of 15 lakh $9,000 per case. Asset misappropriation was the most. Now this is the fraud triangle: incentive pressure, rationalization or attitude, and the opportunity. The major corporate frauds: Satyam Computer, Kingfisher Airlines, Jet Airways, Bhushan Steel, PNB fraud, ILFS, Waste Management, Arm Corporation Scandal 2001, and the World Home. Application of forensic accounting, bankruptcy, insolvency, and recognition. Computer forensic analysis, economic damage calculations, family law, financial statement and misappropriation, fraud prevention, detection of response, business valuation. The type of fraud, the fraud which can play in the cycle: larceny, skimming, check tampering, register disbursement. In addition, through front end frauds also in the cycle: theft in case of hand, employee steals the cash outrightly, employee uses the cash for his personal use for a period of time and replaces the same at the time of reconciliation, or may book the shortfall through a fictitious book entry. The theft of cash receipts, the theft of cash receipts can be done. Now the assets: cash and inventory and other assets. Cash, large cash on hand from the deposits and others. Skimming, sales, unrecorded and understated. Reversible, write-off schemes, lapping scheme, unconcealed scheme, then refund and others. The fraudulent disbursement are billing schemes, shell companies, non-accomplished e-vendor, personal purchases, payroll scheme, ghost employees, commission schemes, workers' compensation, falsified wages. Then another is expense reimbursement scheme, mischaracterized deposit expenses, overstated expenses, fictitious expenses, multiple reimbursement scheme, check tampering, forged maker, forged endorsement, altered pay, concealed checks, authorized maker, registered disbursement, false voids, false refunds. Then inventory and all other assets: misuse and larceny, asset requisitions and false sales and shipping, purchasing and receiving, unconcealed larceny. Fraud origin and accounting cycles. Scheming is the process by which cash is removed from the business before a formal entry of the cash is made in the accounting reports. This is an off-book scheme because the cash receipt is neither reported nor entered in books of accounts. The common scheming scheme are sales scheme, unrecorded sales, understated sales, account receivable scheme, write-off scheme, lapping scheme, unconcealed receivables, refund, and other schemes. Sales and collections receipt cycle, purchase and payment disbursement, personal and payroll scheme, ghost employees, commission scheme, workers' compensations, fraud, falsified wage scheme, expense reimbursement scheme, inventory and warehousing, monthly reconciliation and reporting. The scheming and the process by which cash is removed from the business before a formal entry of the cash is made in the accounting record. This is an off book scheme because the cash receipt is neither reported nor entered in the book account. The common scheming schemes are sales scheme, unrecorded sales, understated sales, account receivable scheme, write-off scheme, lapping scheme, and uncollected receivables, refund, and other schemes. Under the scheming sales scheme, the sales are either unrecorded or understated. This is a true for business where the primary mode of transaction in cash, detection of net of cash receipt schemes, analyze cash receipt and their recording, analyze deposit slip book, analyze sales account by an employee, analyze the gap between receipt from customer and the date the payment are posted on customer's account, review entries in the book regarding, create the inventory account to conceal uncovered, unrecorded, and understated sales, write-off of inventory due to lost, stolen, or obsolete products, write-off of accounts receivable, analyze the relationship between the sales and the cost of sales and sales return, and allowances on sales. The fraudulent financial reporting schemes, over reporting and under reporting of revenues are the two methods used by the business depending upon the motivation of the people running the business. The following methods are used for overstating revenues, accelerating shipments, keeping books open in order to record sales often made at the end of the accounting period, recognizing transactions as sales which are not yet sales. Example includes consignment, sales not yet sold to the end user, sales with a special condition, certain file and hold transactions, products shipped for trial or evaluation purposes, swaps or round trip trades, and related party transactions, non-adjustment in class sales by understatement of returns, discounts and markdowns, fictitious sales, then the review recognition detection techniques through cut-off testing determine whether sales were accelerated or discredited. That can be found out by examining purchase orders, invoices, and shipping documents, comparing the billed volume and shipping volumes, analyzing ending inventory, examination documents for pre and post dating, examining logistics and warehousing documents, looking for large shipment near the period end, significant returns and bill and hold transactions, analyze large transactions near the end of an accounting period with a new customer with a related party, analyze new customers making large purchases, confirms physical location of purchasing entity, review transactions after the closure of the accounting period for evidence of invoicing and payment or cancellation of returned goods, seek confirmation from customers regarding volume, amount, dates and side agreements, and pay. Now the important revenue recognitions, side agreements, round trip transactions, bill and hold, altering shipping documentation, upfront fees, holding accounting period open, non-recording of sales provision for allowances, inventory schemes, inflating, deflating the value of inventory, offsite or fictitious inventory, Now, other financial reporting schemes are fraudulent audit confirmation, inflating, deflating the value of inventory, offsite fixation inventory, perfrest receivables, promotional allowance manipulations of balance sheet entities and liabilities, improper asset valuation, capitalization of expenses, phony investment deals, adding back outstanding check to cash, related parties transactions and disclosure frauds. The tools for fraud detection are Helix is the software based on Knoppix, a variant of Linux, which is used to acquire forsi- forensically sound images of hard drives and hard drive partitions of system. ACL Desktop, also known as Audit Command Language, is a tool to read and analyze various types of tiles scattered across multiple databases on different platforms. A unique feature of ACL is its ability to maintain data integrity as its method of accessing the data is read-only access. Due to this feature, source data is never changed, altered, or deleted. This is the categorization of fraud detection method. Now, the fraud non-technology based, chance, tip received, hotline, or fortuitous. Then fraud technology based, computerized traditional method, discovery sampling, financial statement analysis. Another is strategic method, pupil, bad guy, behavioral analysis, transaction focused, inductive analysis, deductive analysis, data mining software, digital analysis, Benford, strategic fraud. Then methods of fraud detection, there are two main methods used to detect the fraud, which is supervised and unsupervised method. The forensic audit techniques are testing internal controls, trend analysis, digital forensic examination, face-to-face interview, full financial audit, application of Benford's law, theory of relative size factor, computer assisted auditing tools, data analysis ratios, the ratio of the highest value to the lowest value, the ratio of the highest to the second highest value, the ratio of the current year and the previous year, Bannish ratios. So now we come to back on the fraud triangle. This is fraud triangle. Fraud triangle is there are three types: incentive or pressure, personalization or attitude. Then third is the opportunity. Sometimes there is a pressure on the staff by the management. Then higher budget is given, which is not possible to achieve during the financial year, and they have to do some cross selling also in addition to their usual business. Suppose some field staff is working in the field, he has given target that he has to achieve a certain loan business, and similarly he has been given target that he has to cross sell the product of their other uh, sister concern like insurance. So the field staff will be under pressure to sell the insurance product, and for that he will manipulate from the loan takers to invest some money in that insurance scheme. So he will take over invoicing and over financing, which may result later on in non-performing assets. Sometimes the salary or the incentives are linked with the work, that so much work will be done, so much will business will be done, then he will get this salary and incentive. To achieve that target, the staff is overburdened and he sometimes lose the techniques and give higher loans to achieve their targets so that his salary is protected. So the employee is under pressure. Such pressures sometimes may lead to fraud. Now the rationalization and the attitude, the sometimes the attitude of the employee is not good. He tend to do if get opportunity the frauds. Sometimes the person who are posted in such a desk that he do not get opportunity, so he may not be able to do the fraud, but when he gets opportunity and he can do the fraud. So there are these three triangles of the fraud: incentive or pressure, personalization or attitude, and opportunity. Then the frauds which can play the cycle of larcency, skimming, check tampering, disbursement in addition to the upfront, and fraud also the cycle, theft of cash on hand, employee steals the cash out rightly, employee uses the cash for his personal use and for a period of time and replaces the same at the time of the reconciliation or make good the shortfall through a fictitious book entry. Actual cash is not deposited. Then the theft of cash receipt. Theft of cash receipt can be done. Skimming is the process by which cash is removed from the business before a formal entry in the cash is made in the accounting records. This is an off-book scheme because the cash receipt is neither reported nor entered in the books of the accounts. The common skimming schemes are sales scheme, uncovered sales, undistributed sales, account receivable scheme, write-offs, lapping scheme, unconsoled receivables, refund, and other schemes, sales and collections, receipt cycle, purchase and payments, disbursements, personals and payroll scheme. Sometimes the host employees are uh, mentioned in the payroll, which are actually not in existence, and the payments made to those host employees' accounts are actually taken out fraudulently by the person who is maintaining the payroll. Now, the commission scheme, workers' compensation, fraud, falsified wage schemes, expenses, reimbursement scheme, inventory and warehousing, your monthly reconciliation and reporting. Sometimes monthly reconciliations are not done, and if done, the actual stock is not available, but book in books, the reconciliation is made and reporting. The scheme is the process by which cash is removed from the business before a formal entry of the cash is made in the accounting records. This is an off-book scheme because the cash receipt is neither reported nor entered in the books of the accounts. The commonest making schemes are sales scheme, unrecorded sales, understated sales, account receivable schemes, write-off schemes, lapping schemes, unconcealed receivables and refund and other schemes. Under the skimming sales scheme, the sales are either unrecorded or understated. This is true for business where the primary mode of transaction is cash. Detection of the theft of cash receipt schemes, analyze cash receipts and their recording, analyze the deposit slip book, analyze the sales account by an employee, then analyze the gap between the receipt from the customer and the date the payment are posted in the customer's account, review of entries in the books regarding credit to the inventory account, to conceal unrecorded or understated sales, write-off of inventory due to lost, stolen, or obsolete products, write-off of accounts receivable, analyze the relationship between the sales and the cost of sales, sales and the sales return, and allowances on sales. The fraudulent financial reporting schemes are over-reporting and under-reporting of the revenues are the two methods used by the business depending upon the motivation of the people running the business. The following methods are used for overstating the revenues. Now the accelerating shipments, keeping books open in order to record the sales often made at the end of the accounting period, recognizing transactions as sales which are not yet sales. Example includes consignment sales not yet sold to the end user, sales with a special condition, certain file and hold transactions, product shipped for trial and evaluation purposes, swaps or round trip trades and related party transactions, non-adjustment in gross sales by understatement of returns, discounts and markdowns, fictitious sales, the revenue recognition detection techniques through cutoff testing determine whether sales were accelerated or decelerated. This can be found out by examining purchase orders, invoices, and shipping documents, comparing the billed volumes with shipping volumes, analyzing ending inventory, examining documents for pre and post dating, then examining logistics and warehousing documents, looking for large shipment near the period end, significant returns and bill and hold transactions, analyze large transactions near the end of an accelerating period with a new customer with the related party, analyze new customers making large purchases, confirms physical location of purchasing entity, review transactions after the closure of the accounting period for evidence of invoicing and payment or cancellation or return of goods, seek confirmation from customers regarding volumes, amount, date, and side agreements and pay. Now, the improper revenue recognition, side agreements, round trip transactions, bill and hold, altering shipping documentation, upfront fee, holding accounting period open, non-recording of sales provision and allowance, inventory schemes, inflating, deflating the value of inventory, off-site and fictitious inventory. The other financial reporting schemes are fraudulent audit confirmation, inflating, deflating the value of inventory, off-site or fictitious inventory, refreshed receivables, promotional allowance, manipulations of balance sheet entities and liabilities, improper asset valuation, capitalization of expenses, phony investment deals, adding back outstanding check to cash, related parties, transactions, and disclosure frauds. The tools for detection are Helix software based on Nopix, a variant of Linux, which is used to acquire forensically sound images of hard drives and hard drive partitions of system. ACL Desktop, also known as Audit Command Language, is a tool to read and analyze various types of tiles scattered across multiple databases on different platforms. A unique feature of ACL is its liability. ACL is its ability to maintain data integrity as its method of accessing the data is read-only access. Due to this feature, source data is never changed, altered, or deleted. Now, this is the method of fraud detection. There are two main methods used to detect the fraud, which is one is the supervised method and another is unsupervised method. The forensic audit techniques are testing internal controls, trend analysis, digital forensic examination, face-to-face interview, full financial audit, ap- application of Balfour's law, theory of relative size factors, computer assist auditing, tools data analysis ratio, the ratio of highest value to the lowest value, the ratio of the highest to the second highest value, the ratio of the current year to the previous year, and the Benz ratio. Now we have covered MMPS 004 from unit number 1 to unit number 16. Namaskar.
आ जा रही टाइम तो हो गया
मैंने वो बोल दिया कि भाई ये MMPC 4 प्रोग्राम का 1 से 16 तक की यूनिट हमने कवर कर दी है और बस वो ऊपर से वो कर दिया।